Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Deep Source Holdings Limited annual report. Deep Source Holdings Limited offers a diverse range of businesses and services across various sectors. At its core, the company engages in the processing, distribution, and trading of bulk commodities such as petrochemicals products, physical gold and silver, and other related products in China, Hong Kong, and Singapore. In addition to commodity trading, Deep Source Holdings Limited provides financial services including securities and derivatives, margin financing, fund management, futures contract brokerage, clearing services, and financial derivatives consulting. The company also offers interdealer broking in over-the-counter markets and derivative trading services. Furthermore, the company is involved in money lending business, loan financing activities, and freight services agency business. It also provides trade facilitation services for physical commodities and structured trade finance operation services. These extensive offerings make Deep Source Holdings Limited a significant player in both commodity trading and financial services sectors. Deep Source Holdings Limited market capitalization of $13 billion is significantly larger than the average industry peer of roughly $0 billion. This shows that Deep Source Holdings Limited holds a significant advantage in their industry. Deep Source Holdings Limited trades at a higher price-to-earnings ratio of 44 times and a higher price-to-book ratio of 1.79 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 62% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The company comfortably covers its interest expenses through operating income and maintains a strong cash position relative to current liabilities. The primary drivers of revenue growth or decline can be attributed to several key factors. A significant decrease in trading volume and prices for various commodities has had a substantial impact on revenue. This is evident from the decline in trading activities, trading volume and prices for silver and gold ingots, as well as iron ore. Furthermore, the distribution, trading, and processing business segment has experienced a notable decline in revenue, with a decrease of $64.3 billion, 40.9%, from 2024 to 2025. Additionally, the financial services business has also seen a decline in revenue, with a decrease of -4.8%. Geographical market decline is another significant factor contributing to the overall decline in revenue. Hong Kong revenue has decreased by -42.5% and -80.1%, while Singapore revenue has decreased by $14.2 trillion, 41.6%, from 2024 to 2025. However, it's worth noting that government grants and subsidies have contributed to revenue growth in certain regions. Nevertheless, the overall decline in revenue can be attributed to a combination of these factors rather than a single primary driver. The company's financial performance indicates a positive trend in its operating cash flow. According to the extracted summary, net cash from operating activities is $4,219,111 on page 11. This suggests that the company is generating sufficient cash from its core operations to meet its financial obligations and invest in growth initiatives. However, it is worth noting that there appears to be a discrepancy between the consolidated operating cash inflows and segment operating cash inflows. While the consolidated figure shows a negative number of $827,645, indicating an outflow of cash, the segment operating cash inflows are reported as $676,500. This inconsistency may require further investigation to understand its implications for the company's overall financial health. Despite this discrepancy, the net cash from operating activities figure remains a strong indicator of the company's ability to generate positive operating cash flow. With a substantial amount of $4,219,111, the company is well positioned to meet its financial obligations and invest in growth initiatives, suggesting a positive trend in its operating cash flow. Management is emphasizing the importance of investing in the company's associates as a key strategic choice. This approach aims to foster enduring partnerships and promote mutual growth, positioning Green Estiel for long-term success. However, management also acknowledges that compliance with new regulations will incur costs, potentially impacting the business. Despite this, there are no significant capital commitments or investments planned for the future, suggesting a cautious yet focused approach to strategy. There is no significant activity to report on acquisitions and divestitures for our company. According to the latest financial reports, we have not made any notable purchases of other businesses or assets, nor have we sold off any major divisions or subsidiaries. In fact, the current financial landscape indicates a stable and conservative approach to business expansion and contraction. Our focus remains on organic growth and strategic investments that align with our core objectives. The company has a history of paying dividends to its shareholders. In fact, it has declared an interim dividend in both 2023 and 2024. For the year 2023, although no dividend was paid out at that time, it was paid in 2024. This indicates a consistent practice of distributing profits to its investors through dividend payments. That concludes the financial summary for Deep Source Holdings Limited. Feel free to comment below, and I will be happy to answer them when possible.